I want to bring in Scott Bauer. We've got the CEO of Prosper Trading Academy joining us to take a look at the numbers. Scott, I know you've only had a minute to break it down here, but taking a look at the S&Ps, I mean, this is not going to derail anything or really raise too many concerns, I would imagine, right? We know the consumer's slowing, but seems to be at an acceptable pace.
That's the key. We know that they are slowing, but at an acceptable pace, like you just said, Ben. So all of this data coming in that is softer and softer and softer, exactly what the Fed wants to see. The market loves it.
Yeah, definitely. 55.50. I mean, a staggering level to say the least for the S&Ps. I mean, we've been really focusing quite a bit this morning on how tech has been fueling this market higher. But one could argue, Scott, that the data has been supportive of this rally as well.
No doubt about it. And you know what? We are starting to see it broaden out just a little bit. Okay. But tech has been the big winner. And if you look this morning, even, we're 2 minutes after the news here, the 10-year has dropped, 2 or 3? It's down quite a bit here. That is very, very supportive for the rally to continue here, especially in the tech space.
I like that, Scott. You bring up a good point here. I wanted to talk commodities, but to that, just to further that idea a bit, and it sounds like you have a cold, so appreciate you sharing your Tuesday morning with us. Sometimes those summer colds can be the worst, but thanks again, Scott, for pushing through here. From 4.28 into this retail sales number, again, retail sales coming in a little bit below expectations, to 4.24. To your point, we've seen yields coming off. So you've got kind of that triage of supportive, events. You've got tech rally, right? You've got the fact that the numbers have been really good as well. Labor conditions here in the U.S. slowing but not cratering, again, like we just talked about in terms of the consumer. But then also you have yields, which have come off as well amidst the drumbeat from Fed officials. I mean, this is, again, kind of 1, 2, 3, basically exactly what the market's looking for.
Boy, ever since that May jobs report, all of the numbers that have come in have been exactly what the Fed and the market have wanted to see. And we see what the market is doing. It has responded to that. Excuse me. I'm so sorry.
You're all good, Scott.
We just need to be careful that, if this data continues to be weak, if we see this slowdown here, that all of a sudden we don't hit that point where, now the Fed needs to cut because now they really see things are slowing down and maybe slowing down too quickly. We're not there yet, but this is absolutely data that everybody wants to see. And I'll be honest with you, I'm not so sure that July is off the table yet. I know that everybody is saying, there's not going to be no cut in July. September is the one. I'd like to see what the market is pricing in. I haven't had a chance to look at the CME FedWatch tool yet. I bet July is ticking up a little bit here.
Well, we have a special gift for guys that go out on a limb like that, Scott, on the future show here. So if that proves true, you're going to have a nice little package arriving one day, a special surprise headed your way here. But, hey, I just wanted to take a look at this chart here because taking a look at the 10-year, to Scott's point, I mean, here was that Friday in reaction to the jobs report. We spiked up, right, almost to 4.5% to start the week. A week ago on Monday, we started that decline down to 4.18. Again, we're looking at the 10-year yield, and here we are right at 4.24. Look at the move lower we're seeing just in reaction to that retail sales data. Kind of reminds me of what we saw as we start things off in reaction to that Fed announcement last week. But, Scott, let's shift gears a little bit here. Crude oil, fly in the ointment? Should we be concerned as it inches its way back above $80?
Wow. I mean, you look to see what the dollar is doing and look what crude is doing. And I don't know if it's, the summer, if it's OPEC, if it's, the outlook, but everything that we see, the demand is still not there, right? Everything we see is for demand to be falling, yet crude has inched its way right back up to $80. This is an inflection point. I still think that we need to be a little bit cautious here. I would be very, very surprised without anything happening geopolitically if we see crude rally much further from here.
$80, Scott. I'm looking at AAA. According to them, the national average at 344. Basically, a month ago, we're talking around 359. A year ago, This time last year, $3.57. Scott, I filled up the other day for something like $4.79 a gallon here in Chicago. Now, again, out in Indiana, where I go out to the dunes with the dog and stuff, and in the burbs, it's quite a bit cheaper, almost $1 cheaper. But if this pace or if this trajectory continues to the upside, where's that kind of pain threshold lie? What is that level, Scott? 80, 90, 100? I mean, the market's kind of been able to focus on the positive, discount the negative. Crude oil prices on the rise being in that negative column.
It's probably in the mid to high 80s. I think that if you get to the pump and you see a 5 handle, that's when people are exactly. That's when the consumer is really going to say, "Oh no, I've got to start thinking about some alternatives here." Again, you make a good point. In the city of Chicago, there's so many additional taxes, and that's why you paid that $4.70. Because out by me, it's like $3.50 in the suburb. But nonetheless, if we start seeing a 5 handle on that again, that's where you could start seeing people, really, really taking heed and saying, I've got to change my habits a little bit here.
Scott, really appreciate you joining us this morning and pushing through ultimately to take a look at commodities, take a look at the number here. Scott Bauer, CEO of Prosper Trading Academy.